one particular country or a series of countries, and perhaps maybe next they move on to Japan and eventually the United States?
Well, yeah, it's not quite that simple, I don't think. I don't think they sort of say, well, who are we going to go to next? As events evolve, people start selling in mass in some countries, obviously. It became so apparent that Greece was in trouble that everybody sold Greece at the same time. And that's happening if people look around for who else is in trouble. Eventually, yes, it's going to go to Japan. Eventually, it's going to go to the U.S. The Japanese have been able to hold their interest rates at artificial levels for, goodness knows, well over a decade now. Maybe 15, maybe even almost, not 20 years yet, but certainly for a long, long time. But that, again, is the same thing. Their central bank keeps printing money and buying bonds. This is all going to end very badly, Jim, as you well know. And they have the advantage that the Japanese have the advantage. They don't have to borrow from the outside world. They can borrow internally, so they can get away with it. But eventually, all bond markets around the world are going to go into a secular bear market, and we're going to have 15, 20, 30 years of a bear market in bonds. Now, that may sound strange or absurd even to some people, but look back in history. You will see that in the past several hundred years, the way bond markets have worked, we've had long bull markets. In fact, bonds in the U.S. were in a bear market from 1946 to 1981, and then they turned around. That's, 35 years, and they turned around and went into a bull market starting in 81, and here it is 2012, so that's 31 years later of a bull market. So long, multi-decade bull markets in bonds are not unusual. And when this bull market ends, it's going to turn into a long, multi-decade bear market. So if you're a bond portfolio manager, Jim, I would urge you to get another job.
Now, given what we've been talking about, central banks printing money, we know how this ends, and you're on record that you own real assets, and you just mentioned you're shorting U.S. government bonds recently. Is that how you would play this? You would own, let's say, commodities or commodity stocks. Would you own the commodity stocks versus the commodities?
Well, if you're a good stock picker, yes, you will make a lot more money in a commodity stock. If you know a company that's going to find natural gas or oil in Berlin, you should buy all the stock you can. Then you should call me, Jim, because I want to buy it too. But there are hundreds of natural gas companies and oil companies. But if you're a good stock picker, certainly you'll make a lot more money in a stock, and that's a way to do it. You can also buy commodities directly or ETFs or indexes. There are plenty of ways to invest in commodities, or you can invest in commodity countries. Canada has done better than the U.S. and will continue to do better than the U.S. because it's a commodity country. Australia will do better than Belgium because Australia is a commodity country. Belgium is not. You know, department store chains in Canada are going to do better than retailers in the U.S. Restaurant chains are going to do better in Australia than they are in Belgium because the whole economy is going to be much better.
Finally, Jim, you wrote a book called Hot Commodities, How Anyone Can Invest Profitably in the World's Best Market. That came out in March of 2007. If you were to look at that book today, would you add any more to it? Has anything changed since you've written that book?
No, the only thing that's changed is prices, of course. Prices are up since then, certainly since I wrote the book and since I started being bullish on commodities again back at the end of the 1990s. I'm sure there would be some nuances here or there, some sentences or even paragraphs, but no, the basic thesis is still the same. We have a shortage of supply caused by a lack of or not enough investment in productive capacity for several decades, and now we have to pay the price. This is another thing which has recurred throughout history. We've had long bull markets in commodities, followed by long bear markets, followed by long bull markets again. People say I'm some kind of smart guy, but Jim, I want you to know I'm not. I just went and looked it up. Anybody can go look it up, and you can see the same thing. It's simple stuff. It's always worked this way. And I guess the only thing I would add is that the situation has gotten worse in that, normally when you're 8 or 10 or 12 years into a bull market, people start adding capacity, whether it's tankers or real estate or stocks or whatever it is. By 2008, we were 9 years into the bull market, and in commodities, and you know what happened. So a lot of people who were thinking of adding capacity have canceled or delayed or rescheduled or suspended. So some capacity which should have been coming on, or normally would have been coming on by 2012, 2013, is not coming on. So the supply situation is getting even worse for commodities going forward. Agriculture is downright desperate almost because, Jim, the average age of farmers in America is 58 years old. In Japan, it's 66 years old. The highest rate of suicide in the UK is in agriculture, because it's been such a terrible business. In India, hundreds of thousands of farmers commit suicide every year because it's such a terrible business. In Australia, the average age of farmers is 58. In 10 years, those guys will be 68 if they're still alive. So, Jim, the world is facing serious, serious shortages in agriculture, and prices are going to go much, much, much higher. Or we're not going to have any food at any price. And if that's the case, then the sky's the limit for food prices.
A lot of people have called for that this bull market in commodities is coming to a close, and several respected analysts. This commodity bull market, as you talked about, began in 1999. It's still going. We're probably in our 13th year. Where do you think we are in this cycle? Because this one looks more pronounced in terms of its longevity than the previous one, because as you just mentioned, Jim, with higher prices because of what happened in 2008, a lot of oil companies canceled some projects, mining companies canceled projects. So instead of making the needed investment to bring and expand capacity, that hasn't happened, which tells me that this market's got a long ways to go.
Well, I'm in the same camp as you. Anybody who says the bull market is over, I would just, first of all, I would suggest they short commodities. That's what they think. But second, and I'm not, obviously, the second thing is I would like to know where the supply is that's going to end this bull market. And if the answer to that is, it doesn't matter about supply because demand is going to go down, well, if demand does go down, governments are going to turn around and print money. That's all they know to do. That's what they've always done, and they will print money. So either way, it seems to me that commodities are the place to be in the investment world in the next several years because of the supply-demand dynamics and or because of money printing. And I don't see it coming, again, to repeat, the best place to be relatively, if nothing else, is in commodities, because if the world economy gets better, commodities will do well because of the shortages. If the world economy does not get better, they're going to print money, and then the only place to be is in real assets.
I couldn't agree more. Well, listen, Jim, I want to thank you for coming on the program, and I just want to put a little plug out for some of the books that you've written. One I thought was rather interesting is A Gift to My Children, A Father's Lessons for Life and Investing, as you impart wisdom to your daughter, and Hot Commodities, which you wrote how anyone can invest profitably in the world's best markets. We've been speaking with Jim Rogers, chairman of Rogers Holdings. Jim, I want to thank you for joining us on the program.
Thank you, Jim. Let's do it again sometime.
All right. Bye-bye.
You can subscribe to Financial Sense News Hour in the iTunes and BlackBerry podcast libraries or at feeds.feedburner.com/FSN. Find more information about our guests at www.financialsense.com/newshour. Friend us at www.facebook.com/financialsenseonline. For our on-the-go listeners, you can access Financial Sense on your mobile device at m.financialsense.com. The Financial Sense News Hour is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the News Hour each involve their own unique risk factors, which are not discussed on the show. Responses to listener inquiries are based on the personal opinions of James Poplava and do not take into account listeners' suitability, objectives, or risk tolerance. Financial Sense NewsHour and its parent company shall not be liable for any financial losses that result from investing in any companies profiled on or advertising with Financial Sense, or arising out of the use of any material on the NewsHour. Be advised that you invest at your own risk.